To understand the enduring wisdom of a master like Jesse Livermore, one must first grasp this central and profound truth. The speculator of the early 20th century and the trader of the year 2025 are, in the final analysis, the same man, fighting the same internal battle. The external form of the market has transformed, but the inner substance of the game is unaltered. This is an analysis of that great contrast and that great unchanging constant. It is a dissection of the world that Livermore mastered, a world of telegraphs, of chalkboys, of delayed tickers and powerful visible manipulators, and a comparison to the modern battlefield of algorithms, of artificial intelligence, and of light-speed information. And it is ultimately a demonstration that the timeless principles of success, forged in the brutal, simple markets of the past, are not just relevant, but are more essential than ever for survival in the complex, high-speed markets of the present. The game has changed, but the rules for winning it have not. The principles and the stark observations that form this analysis are not new theories. They are the hard-won, time-tested laws of the market, paid for with millions of dollars in losses and proven with millions more in profits. They are the core of the philosophy so masterfully chronicled by Edwin Lefebvre in his definitive work on the mind of a professional speculator. A link to that essential book, Reminiscences of a Stock Operator, now with a unique, detailed, chapter-by-chapter analysis from Max Davidson, is left in the description below this video. This new analysis is specially designed to make the timeless wisdom of the book powerfully relevant to the modern reader. Let us first, then, step back in time. Let us paint a picture of the world in which Livermore learned his craft. The market of the early 1900s was a physical, tangible, and deeply human place. Its nervous system was not a fiber optic cable, but the clicking, clattering telegraph, spitting out a thin ribbon of paper, the ticker tape. This tape was the river of life for the speculator. It was the one true source of information. It did not offer opinions or analysis or predictions. It offered only the cold, hard, and impersonal facts of price and, to a lesser extent, volume. To learn to read the tape was to learn the secret language of the market. In the brokerage houses, the customers' rooms, this information was made visible. A quote boy, often a young man at the beginning of his own financial education, would stand before a great black slate and chalk up the numbers as they came over the wire. The atmosphere was one of smoke, of noise, of the collective audible gasp or cheer of the crowd. The information itself was not instantaneous as it is today. For the speculator operating away from the floor of the exchange, the ticker was often several minutes behind the real action. This slight delay, this enforced pause, was a feature, not a bug. It made the frantic, second-to-second scalping of today an impossibility. It forced a man to think in terms of the slightly larger swings. The very structure of the game was different. A significant portion of a young speculator's education was earned in the illicit bucket shops. These were not brokerage houses that executed orders on a real exchange. They were, in the simplest terms, gambling dens. A customer in a bucket shop did not buy a stock. He placed a bet against the house on the direction of a stock's price. The shop took the other side of that bet. Since the vast majority of the public loses money, the bucket shop was an immensely profitable enterprise. To succeed in this environment required a very specific skill, the ability to read the tape for the immediate, short-term fluctuations with near-perfect accuracy. It was a game of pure tape reading, unburdened by any thought of fundamentals, of economics, or of the companies themselves. This was the school in which Livermore was trained. He mastered the art of beating the bucket shops, a feat so rare that he was eventually banned from them. He had proven that he could, with his scientific reading of the tape, consistently outwit a system designed to fleece the amateur. But the larger market of his time was also defined by a profound and dangerous asymmetry of information. In the age before strict regulation, the insiders, the company directors, the great bankers, the pool operators, had all the information. The public had almost none. The average man traded not on analysis but on rumors, on gossip, and on the deliberately manipulative stories planted in the newspapers by the great operators. He was a sheep, and the insiders were the wolves. This led to the great and common phenomenon of the pool operation. A powerful group of insiders would quietly accumulate a large line of stock, then work in concert to create a public excitement, to mark up the price, and then to distribute or sell their holdings to the hopeful, greedy public at the top. The game was, by its very nature, rigged. The primary force a speculator had to understand, therefore, was the raw and unrefined psychology of the crowd. Market booms were driven by a contagious, almost hysterical greed. Panics were visceral, physical events, driven by men shouting on the floor, by the sight of a crowd gathering outside a failing bank. The emotions were the same as they are today: fear, greed, hope, and ignorance, but they were expressed in a more direct, more collective, and less technologically mediated way. The speculator's job was to be a dispassionate psychologist, observing the madness of the crowd and betting against its predictable emotional extremes. This, then, was the world of the 1900s. It was a world of imperfect information, of open manipulation, of delayed communication, and of raw, naked human emotion. It was a simple, brutal, and honest game in its own way. Now consider the battlefield of the year 2025. The great physical floor of the exchange has been replaced by a silent global network of servers housed in cold, dark data centers. The roar of the crowd has been replaced by the quiet hum of cooling fans. The ticker tape is no longer a thin ribbon of paper. It is a fire hose of light-speed data, a torrent of information so vast and so fast that no single human mind can possibly comprehend it in its entirety. The game is no longer played at a human pace. The combatants themselves have changed. The old human floor trader, the specialist, the pool operator, have been replaced by a new and superior species of predator. These are the algorithms, the high-frequency trading firms, the quantitative hedge funds. These new players operate on a time scale of microseconds, a millionth of a second. They can see an order being placed and can front-run it before the human who placed the order is even aware that his signal has reached the exchange. They are the new insiders, but their advantage is not in what they know, but in how fast they can act. The very nature of buying and selling has been transformed. A large institutional order is no longer placed by a single man. It is broken down by a sophisticated algorithm into thousands of tiny, iceberg orders, designed to conceal its true size and intent. The art of accumulation and distribution has become an invisible electronic science. A new form of intelligence has also entered the game: artificial intelligence. These are the new tape readers. They are machines that can analyze decades of price data, that can read and interpret every news story and every social media post in the world in real time, searching for an edge, a pattern, a flicker of sentiment that can be traded upon. The old problem of a lack of information has been replaced by its opposite: a tsunami of information. The modern trader is not starved of data. He is drowning in it. He has access to instant news from every corner of the globe, to the opinions of thousands of self-proclaimed experts, to a million different charts and indicators. This abundance of information is not, as one might think, an advantage. It is a new and more subtle form of deception. The constant 24-hour stream of news and opinion is designed not to create clarity, but to create an emotional reaction. It is a machine for generating fear, greed, and a desperate need to act. The modern trader's great challenge is not in finding information, but in finding the signal within the overwhelming and deafening noise. The problem of the 1900s was scarcity. The problem of 2025 is overstimulation. And yet, despite this complete and total transformation of the external game, the internal game remains profoundly and eternally the same. For the operator of the modern sophisticated trading terminal is still a human being. And the human heart, as the old book says, is deceitful above all things. The greed that fueled the wild railroad booms of the 1900s is the exact same primal greed that fuels a 2025 mania in a meme stock or a cryptocurrency. It is the same timeless, irrational desire to get something for nothing. The fear that caused the Great Panic of 1907 that turned sane men into a stampeding herd is the exact same biological fear that can trigger a flash crash in the modern algorithmic market as thousands of human operators hit the sell button in a moment of collective panic. The emotional traps that ensnared the speculator of the past are the very same traps that await the trader of today. The technology has evolved, but the human being has not. The hope that caused a man in 1910 to hold on to a losing position to whisper to himself, "It must come back," is the same hope that causes a man in 2025 to stare at his screen, his account bleeding, and to refuse to take his loss. The ego that made a man in the past believe that he was smarter than the market, that he could average down his losses and prove his own genius, is the same ego that drives the modern trader to violate his own well-tested rules. The market, therefore, remains what it has always been, a great and impersonal machine for exploiting these timeless and predictable human weaknesses. The algorithms and the high-frequency traders of 2025 are simply a more efficient and more ruthless tool for doing what the great pool operators of the 1900s did by hand. They are designed to hunt for stop losses. They are designed to trigger emotional reactions. They are designed to profit from the predictable patterns of human fear and human greed. The predator has changed its form, but its nature is the same. It is in these moments of great emotional pressure, whether in the chaos of a 1907 panic or the silent, swift terror of a 2025 flash crash, that a speculator's true character is revealed. It is for this reason that a constant return to the first fundamental principles of the game is not a luxury, but an absolute necessity for survival. A return to this channel, to this video and others, especially after a series of unsuccessful trades has clouded one's judgment, serves as a vital recalibration of the mind to the professional, scientific, and unemotional approach. The great contrast between the two eras is undeniable. The external form of the game, its speed, its tools, and its players, is a world that a speculator from 1900 would find utterly alien and incomprehensible. But the internal substance of the game, the psychological and emotional battle that is waged within the mind of the individual speculator, is a world that has not changed by a single solitary atom. Therefore, the great and timeless principles for winning that internal battle must also remain unchanged. The rules for mastering one's own human nature, for subordinating the powerful emotions of hope and fear to a disciplined and scientific plan, are as valid and as necessary in 2025 as they were in 1900. The man who believes that new technology requires a new set of fundamental principles is a man who is destined to learn, through painful experience, that the game itself is new, but the human heart is old. The study of a master like Livermore is therefore not a study of history. It is a study of timeless, universal, and unchanging truths about the one great constant factor in the market, man himself. In the face of this new and terrifyingly efficient market of 2025, a market of silent algorithms and light-speed transactions, the amateur speculator is seized by a predictable and fatal impulse. He believes that a new and more complex game requires a new and more complex set of tools. He searches for the magic algorithm, the secret indicator, the AI-driven profit that can outwit the machine. He does not understand that this is a fool's errand. To try and beat the machine at its own game of speed and complexity is to be a foot soldier charging against a squadron of tanks. The human operator cannot win on these terms. His mind is too slow, his emotions too volatile. The master speculator, the man who would survive and prosper in this new era, understands a profound and counterintuitive truth. The answer to the new complexity is not a greater complexity. The answer is a return to a stark and timeless simplicity. In this chaotic new world, the old, fundamental, and psychologically grounded rules are not obsolete. They have become the one and only true compass that can guide a human speculator through the storm. They are the bedrock of sanity in a world of algorithmic madness. The trader who tries to fight the new machine with new complex weapons will be destroyed. The speculator who uses the timeless principles of human psychology and disciplined risk management to navigate around the machine is the one who will prevail. Let us, therefore, examine these old, eternal rules one by one and see how they are not just relevant, but are the specific and perfect antidote to the unique dangers of the modern market. Consider the first and most important of all speculative laws. Cut your losses quickly. The amateur of 1900 violated this rule out of hope and ego. The amateur of 2025 violates it for the same reasons, but the consequences are now far more swift and brutal. The modern market, driven by high-frequency trading and momentum algorithms, is a machine that is designed to create vicious and rapid whipsaws. It can shake a trader out of a position and reverse in the blink of an eye. The speed of the losses can be breathtaking. In such an environment, a rigid and automatic stop-loss rule, such as Livermore's 10% formula, is more critical than ever before. It is the one non-discretionary mechanical circuit breaker that can protect a human trader from being chopped to pieces by the machine's inhuman speed. The speculator must understand that he cannot outtrade the algorithm on a moment-to-moment basis. To try and do so is to be guaranteed of ruin. He must therefore have a predetermined rule, a line in the sand, that takes the decision out of his own slow and emotional hands. The stop-loss is the human's only true defense against the speed of the machine. Now consider the great positive corollary: let your profits run. The amateur of the past was tempted to snatch a small profit out of fear. The modern trader is subjected to a level of psychological pressure that is 1,000 times greater. He is inundated by a constant 24-hour fire hose of news, of expert opinions, of social media chatter, of alarming headlines, and of meaningless algorithm-driven price fluctuations. This entire information ecosystem is designed to create a state of perpetual anxiety. In this state, the discipline to sit tight with a winning position becomes an act of almost superhuman mental fortitude. The temptation to take the small, sure profit and to relieve oneself of the nervous strain of the constant noise is immense. But the great law remains unchanged. The life-altering money is not made in the wiggles. It is made in the great primary swing. The discipline of sitting tight is the ultimate defense against the modern information overload. It requires the speculator to have a profound and unwavering faith in his own original judgment, a judgment based not on the noise of the day, but on the great underlying trend of the market itself. He must learn to trust the primary trend and to shut out the deafening and often deliberately manipulative chatter of the world's opinions. Now let us examine the great unpardonable sin: never average down a losing position. In the past, this was a mistake born of a simple, stubborn refusal to admit error. In the modern market, it is a mistake that is amplified by a new and more seductive force: the power of the narrative. The modern market is a market of powerful stories. A charismatic CEO, a revolutionary new technology, a movement of retail traders. These narratives can become so compelling that a speculator falls in love with the story of a stock. He becomes a true believer. And when the stock begins to decline, when the algorithm-driven tape is telling him a clear story of distribution and weakness, he refuses to listen. He clings to the narrative. He tells himself that the market is wrong and the story is right. Averaging down in the modern market is the act of betting on a story against the cold, hard, mathematical reality of the price action. It is a form of faith-based investing which has no place in the world of scientific speculation. The timeless rule to never reinforce a failure is the ultimate protection against this powerful modern trap. It is the discipline that forces a speculator to believe the tape over the tale, the facts over the fiction. Consider the great virtue of patience. The market of the 1900s, with its delayed ticker, had a certain enforced slowness. The market of 2025, with its 24-hour news cycle and its instant phone-based trading apps, is a machine designed to destroy patience. It creates a powerful psychological addiction to action. The modern trader is constantly being stimulated, constantly being shown new movements, new opportunities, new reasons to get in the game. The quiet, disciplined act of doing nothing has become almost impossible. And yet, the fundamental nature of opportunity has not changed. The great, clear, high-probability pivotal points are just as rare today as they were in 1910. The vast majority of the market's action is still just meaningless, random noise. The professional, therefore, must cultivate the virtue of patience with an almost religious devotion. He must understand that the algorithms and the high-frequency traders thrive on the constant small-stakes activity of the impatient amateur. That is their source of profit. The patient professional refuses to be their food. He waits. He knows that his job is not to trade, but to make money. And he knows that the money is made by waiting for the one perfect moment when the odds are overwhelmingly in his favor. In a market that is always on, the discipline to be in cash is the ultimate expression of mastery. Now consider the great foundational principle of trading in harmony with the general market. In the modern market, with its meme stocks and its sector-specific manias, it can be tempting to believe that an individual stock can defy the overall trend. The amateur is constantly searching for this one lone wolf stock, this one company that will soar while the rest of the market declines. This is a form of speculative vanity, a desire to be the one who outsmarts the great tide of the market itself. Livermore knew this to be a fool's errand. While it is true that a stock can, for a short time, move against the general trend, the highest probability, the safest, and the most profitable trades are always, without exception, to be found in the leading stocks of the leading groups in a market that is moving in a clear, primary direction. This principle is even more important in the algorithmic age. The great quantitative funds and the major institutions which drive the market think in terms of sectors and broad market trends. To align oneself with the direction of their immense capital flow is the path of wisdom. To fight against it is the path of ruin. Finally, let us consider the principle of independent thought. The amateur of the past was in danger of being swayed by the gossip of his broker or a tip in a newspaper. The modern trader is in danger of being swayed by the great, global, and instantaneous herd mind of the digital world. Social media, with its viral trends and its powerful echo chambers, can create a sense of overwhelming consensus faster and more powerfully than ever before. The modern tip is a viral tweet, a Reddit forum, a popular financial influencer. The pressure to join this digital crowd to buy what everyone else is buying is immense. It is a powerful and seductive force, but the professional speculator must resist it with all of his will. He must have the courage to stand apart from the digital herd. He must have the discipline to do his own quiet and unemotional reading of the tape. He must trust his own proven system over the hysterical and often deliberately manipulated consensus of the online world. In the final analysis, the great and unchanging lesson is this: the new market, with its speed and its algorithms, is a more efficient, more ruthless, and more psychologically demanding version of the old market. The tools and the players have changed, but the underlying game, the exploitation of the timeless human emotions of hope, fear, greed, and ego, has not changed by a single atom. Therefore, the man who will succeed in the market of 2025 is not the one with the fastest computer or the most complex algorithm. It is the man with the strongest and most disciplined character. The timeless, simple, and profound rules of Jesse Livermore are not just relevant in this new age. They are the one, true, and final key to survival. They are the unchanging compass in the heart of the new technological storm. They are the principles that separate the man from the machine